News. 3 weeks late, but Santa's finally delivered some Christmas gifts for existing homeowners. Today, we received from Statistics Canada the Consumer Price Index report for the month of December, well below any analyst expectations, and that's going to mean good things for the housing market. Besides positive consumer prices, in this video, we're going to talk about central bankers continuing to hike rates into a recession, federal government's institution of the foreign buyer ban, and regulators potentially offering some changes to mortgage rules in Canada. We'll talk about all that and more. Let's jump right into it. Dude, job not done. Job not done, as the late, great Kobe Bryant would say, but what a morning.
It was nice to get some good news.
It was very nice to get some good news. It really has been a while. So many leading indicators telling us that around the corner, we should see a material drop in headline inflation, core inflation, and finally we get it. We had forecast of 0.3 on a month over month for headline inflation, minus 0.6. And that's on headline. So we've got obviously food and energy specifically energy costs driving that down. But I was looking at core inflation on a month over month, and it seems like all categories, particularly services, started to trend down as well. Feels like a TSN turning point a little bit.
It'd be nice if this continues. I think that's going to be the biggest question. We've obviously seen energy prices declining over the last 3 months. We knew that food had kind of plateaued for a little while. The key is going to be what happens over the next 3 to 6 months as people start to figure out what they're doing with finances for the remainder of the year. We know that some of those other key drivers, car sales, all those kinds of things, they're all still coming down. But the energy prices are going to be something to keep an eye out on if Russia decides to continue to escalate, or if we do see the China reopening at a much greater degree. Both those things could add pressures to oil prices, which we'll have to keep a close eye on those.
Well, the interesting part is if we're looking at a year over year comparison for oil prices, but particularly for nat gas, for fertilizer costs as it relates to food, you already have a material year over year plateau, and in many cases already a decline. So there's still some room for those things to run potentially a little bit and still have inflation readings that don't necessarily require additional rate hikes. Like, we're very much in restrictive territory. We saw all the inevitable elements of CPI fall first. So predictably, goods inflation fell first. We're going to see larger ticket purchases like cars, which are very sensitive to interest rates, fall. You can already see it. Like, the Tesla story is pretty vocal out there, and those declines are meaningful. And they're not just meaningful on new car prices, but used car prices are just imploding as we speak. So I think you're going to see that fall through over the next few months. There's going to be a glut of inventory, very little demand, increasing supply at the worst time possible. There's definitely a huge lag in shelter inflation costs. So typically, from what I read, you're looking at like a 6 to 8 month lag time. So to already see headline inflation and core inflation negative on a month over month basis before that sort of filters its way through, I think is pretty positive. And then obviously to see services inflation trend down as well at this point, I think that was one of the biggest concerns over the last few months. That was that last peg that needed to get in line before we could seriously consider that the Fed would possibly look at some form of a pause or pivot. Maybe we're there.
Yeah, it's going to be really interesting. I mean, Canada meets later this week to talk about whether they're moving their prime rate up. This data very, very helpfully comes before that meeting. It'll be interesting to see how they respond to this, because there was still a pretty big expectation that we see further rate hikes. The rate hikes are really tied to the data, as Bank of Canada has been saying at every meeting. So we'll see how much of an influence this data has. There is still some data out there that would suggest that further rate hikes could be needed. Our employment data came in not that long ago, incredibly strong. We're still very tight on the labor market, and we don't necessarily see any sort of relief to that as of yet. So that could be something that the Bank of Canada wants to keep an eye out on. There is enough concern that a tight labor market can lead to wage spiraling, which we know that's a pretty nasty set of inflation drivers, at least from that standpoint. If people continue to earn more, they will continue to keep up with spending. So it's something to keep an eye on as well. But I guess we may as well get in, because one of the questions we're getting asked a lot is how much further do we actually think rates are going to go, if any, where we think they'll peak, and then at what point do we expect them to start coming down?
Well, I don't know. They keep talking to us about a data-driven approach. Today we got CPI. We've got negative readings on a month-over-month basis. We've had, if you look at 3-month trend in inflation, and particularly when you strip out shelter, we've pretty much returned to the 2% target that they had been aiming for. Now, I know you don't want to nitpick data and strip things out just to sort of make your point, but after this month's reading, I think it's fair to say that we're heading to trend and possibly even below that 2% trend. I always see people quoting this year-over-year figure. While I do think that matters, I'm not suggesting it's irrelevant. You also don't want to ignore the fact that for the first time in, I believe, recorded history, we've actually seen a contraction in the M2 money supply over that time. So now more than ever, it feels relevant to be actually quoting the month-over-month figures when we're talking about inflation. Tomorrow, we've got the release of the raw material prices, producer prices, which tend to be a great leading indicator of what we can expect in prices. Over the last 4 months, raw material prices have fallen off the charts. They've returned. They're now bordering on a deflationary print. We'll see how that looks tomorrow. Same can be said for producer prices as well. We've had negative readings in 4 of the last 6 months. So depending on how things look tomorrow, I think there's reason to believe that this is going to be a sustainable trend, but no guarantees. What are you seeing out there? Guys, if you can quickly look down, please hit that like and subscribe button. It'll make sure that this video keeps getting out to the people that really want to see it. It would also mean a lot to me. It would let me know that you guys are really enjoying this format where I bring Devin on. Also, jump into the comment section. We're using the best information we can access to make the best decisions and give the best guidance we can. You might have some different opinions. Let us know down in the comments below, and we could duke it out a little bit there. Let's get back into it.
Yeah, I mean, it's important to understand, and we have to clarify this a lot, is the inflation readings we're looking at are those month-over-month figures. That is the rate of change, not necessarily the fact that the change has occurred. Absolutely, prices are higher today than they were a year ago, and they're still likely to stay at these levels. What we're really hoping for, and what the Bank of Canada is watching, is the rate at which those prices are continuing to move up. So, for anyone who's got that kind of question in their mind, it's like, what do you mean prices are still high? Why is this good news? It's important to understand that the prices have stopped increasing, and that is exactly what inflation is: those prices rising year over year, month over month. So that's really important to understand. It's still a high number as a year over year measure, but the month over month figures are so much more important, because that tells us how much faster we're actually seeing those rises. It's definitely.
Sorry, you had actually asked me, a specific question. I gave you a bit of a vague answer. We were talking about when will interest rates peak? When will they start coming down? And I was having a look at the Fed probability tracker. We had talked about that last week as well. It's basically the bond market's indication of what they anticipate is going to happen moving forward. After the US CPI report came out last week, the probability of a 0.25% hike at the next meeting is now sitting at around 94%. Analyst consensus with Canadian banks is suggesting that on January 25th, when the Bank of Canada meets, we're also going to see a 0.25%. I assume the probabilities of that have actually come down, I would think, pretty materially after today's reporting, and could also be affected by tomorrow's PPI and raw material prices as well. But as far as what the expectation is for rate hikes, more likely than not, 25 basis points coming up at the January 25th meeting. Then we've got one more upcoming meeting before March. Right now, I think consensus estimate is for 0.25 basis point here and one more 0.25 basis point hike as well. That'll be the peak, then a long pause. And the bond market is now pricing in first rate cuts as early as September.
Well, that's not overly surprising. The historical data shows that it's about 7 months between the last rate increase to the first rate cut. If we look at
Mm,
historical Fed rising of rates to then cutting. Now,
hmm.
the cutting is going to be very contingent on how deeply we are feeling this, pending recession that everyone's very convinced is coming. I think
Hmm.
I read recently that this is the most anticipated recession of all time. There's there's generally an enormous consensus that we will see some sort of recession. To what degree, still everyone's best guess, but you'll often get a lot of contrarians look at that and go, well, if everyone's expecting a recession, we may not get one, which is exactly what the Fed is and the Bank of Canada are hoping for. They're hoping for what we'd call a soft landing. So effectively a reduction in those in inflation numbers, a rise of interest rates without material rise in unemployment and effectively a financial collapse of earnings in the stock market.
Hmm.
Um, I'd imagine based on these most recent readings that probability is also increased. So with a soft landing being a greater potential, um, it would also figure that we wouldn't necessarily get aggressive rate cuts, but perhaps a much slower reduction in rates back to that neutral territory. Because as you mentioned, we are in contractionary rate policy right now, which is
Hmm.
putting the brakes on the economy. We don't need to be there if things are
Right.
moving as is, but we certainly don't need to be back to a very aggressive policy that would suggest we're trying to prop up the economy or to spur growth if we don't
Hmm.
see a reduction in unemployment. So it'll be really important to keep an eye out on how well the economy weathers these rate hikes
Hmm.
and really what kind of signs we're seeing for an impending recession. The bond
Well,
market is certainly calling one,
yeah.
but and historically they've been incredibly accurate at doing so.
Hmm.
But we just haven't yet seen a lot of the deterioration in earnings. That's obviously what we're going to have to keep an eye on and see what's to come.
No, I think the interesting part, if you look at sort of leading indications of economic activity, we're returning very much to trend. Whether you look at manufacturing sales, whether you look at the producer managers index of manufacturing and services activity, huge declines in activity as recently as this morning out of the US. Canadian reports came out yesterday. So we're seeing economic activity head towards recessionary territory. The only argument against returning to that 2% target is wage pressure, and hiring remains strong. But there are some leading indications that even that's starting to soften. We do see full-time employment continuing to be added, but it's in very specific industries now. Temporary jobs have actually declined pretty much since June. Inflation peaked, temporary jobs peaked, and they've been coming down materially since. Historically, more often than not, that's been a leading indication that full-time jobs are coming next. The slowdown in economic activity suggests the same. Yesterday, we got the business outlook survey from the Bank of Canada. Business owners in that survey are very much indicating the same thing. They're pulling back on future investment plans, particularly short-term production capacity plans. There's going to be less need for hiring in the near term. And then on the other side of that, we've also got more supply coming to the job market, an increase in permanent residency in Canada, a adjustment to the number of hours that international students could work. We're going to have a larger labor pool able to fill the sort of the sectors of the economy that are seeing the largest growth in employment. Recreational services, restaurants, etc. I can't seem to remember the category for that, but education as well. So I think we are going to see some relief, particularly in wage pressure, as we get a larger supply of people moving back into the labor market. I don't want to jinx it, but the participation rate has also climbed incrementally. So we seem to be heading in the right direction. Particularly in the US, we've seen average weekly hours also trend down. Again, when you see average weekly hours come down, you see temporary jobs being cut. When you see those things, it's basically an indication that before cutting full-time workers, they want to sort of cut the temporary. It's the easier of the two. So,
Yeah.
Dev, I know, in the past, you've sort of played devil's advocate. You've always been a little bit more hawkish than me. I've been pretty dovish for some time, and up until recently, there hasn't really been a compelling side from my side of the story. But what are your thoughts now? Do you think we see rate hikes continue? Do you think we're at the end of the tightening cycle?
Yeah, I think you and I both agree that a pause is coming. for sure. And I think the pause could happen as soon as, after the March hike. It could happen perhaps even in the March hike if the Bank of Canada and the Fed are convinced that, the data is really starting to reflect what they're wanting to see, and they do want to try and avoid a recession if at all possible. I think if we are playing devil's advocate, the Bank of Canada and the Fed, they've both made it very clear they want 2% inflation on an annualized basis.
Mm-hmm.
What we haven't really seen is a lot of alleviation of pressure for some of those key drivers. So we know that commodity pricing is on the way down, and many of those key commodities have come all the way down to pre-pandemic levels.
Mm-hmm.
But China has also been shut down for the majority of those 2 to 3 years. And China is the biggest consumer of commodities on the planet. They produce, a material amount of goods. And now that their economy is starting to reopen, we could see a repricing of some of those commodities to anticipate or to match new demand coming out of China. If we don't see China slow down, or sorry, if we don't see China recover as well as people are expecting him to, then perhaps the bank doesn't need to come off as strongly with any future rate hikes. But I definitely see the bank looking to keep rates high for longer, just to make sure that they don't repeat the same mistakes that were made in the late 70s and 80s, which was effectively a replay of exactly what we're seeing right now. Leading indicators were coming down. We saw pricing falling. We saw CPI actually confirm that. They started to lower rates as CPI fell to try and avoid a soft landing. And what they ended up getting was, to avoid a hard landing or avoid a full-blown recession. What they ended up getting was we call it double top of inflation. Inflation reaccelerated because there was nothing really to support some of those price declines other than repressed demand because rates were high. As soon as they took their foot off the gas, that demand was reignited, prices skyrocketed again, and it took them a substantial amount of effort to get rates back in line, really until real rates got above the inflation rate. And we haven't seen that yet. Our real rates are still below the rate of inflation. We need to, historically, inflation above 5% has never been brought down to its target consistently until real interest rates get above that inflation rate. So we need to see continued material decline on those CPI inflation readings over the next 6 months. And rates need to stay above wherever that inflation line gets to push that all the way down. The other thing we need to keep an eye out on is what's happening with oil reserves. We do know that the war in Ukraine is still going on. Russia is feeding a lot of oil through India to the US. So funny enough, those sanctions are effectively, you could throw those out the window. But if that flow were to stop, or if that demand gets readjusted to someone who's willing to pay a higher price, let's say China, we may see oil prices spike again. I think the Bank of Canada and the Fed have been very, very clear that their only goal is to see inflation turn back into that 2 to 3% range, and it's going to be a bit of a tightrope walk for them. So I just don't see them being as bearish with regards to rate cuts in as near a future. But I do think we see a pause coming in the short term.
Mm-hmm. Yeah, so short term could potentially see a pause as early as March. And as we mentioned before, first cut is expected potentially as early as September of this year. The steepness of those set of cuts could actually potentially see rates being cut up to 2% over the next 18 months. That's currently what the US dot plot has in store. So then the question becomes, how quickly will that re-stimulate the market? Hard to predict, but then we got to think about, how does that then tie into home prices? We know falling interest rates would mean falling qualifying rates. That could potentially set a floor in home prices. We're already seemingly seeing a little bit more buyer demand return to the market, anecdotally up until now. But it's the turn of the year, spring is coming. We've got these other push and pull factors. So one is interest rates for sure. The other is the recent foreign buyer ban. Before we jump into obviously the foreign buyer ban and how it'll affect home prices, we got to understand who that policy is intended to cover against making purchases. So do you want to tell us a little bit about that?
Yeah, sure. So the only clear part of the rule is that non-Canadian citizens, non-permanent residents, are no longer allowed to buy residential property that is 1 to 3 unit homes in metropolitan areas. So things that can still be purchased by non-residents are multi-unit properties, 4 units or more, recreational properties, so cottages, things like that, outside of a particular geographic size. Commercial properties are still okay, but they've done their due diligence to figure out how to close as many, what we can call loopholes as possible. So
Mm,
the ban applies to corporations that are foreign owned or perhaps have foreign ownership as part of them, or what they call non-controlled or non-Canadian controlled corporations. Um, I think that's probably a good summary. There are additional considerations with them. So even amongst lawyers that we're talking to, they are still working their way through the interpretation
hmm.
of the rules, what those changes look like, which is pretty normal. Anytime you get a new set of guidelines out, there's going to be several sets of opinions on them until we start to see the feedback come back from. Um,
Let's give a really practical example of what this means. So let's say you have a non-resident of Canada, citizen of the United States. They meet somebody in Canada, they end up getting married. The person who lives in Canada, they're able to buy. The person who's a citizen of the United States, they can go on title with the Canadian. And in that case, the foreign buyer ban wouldn't apply to them. But let's just say, for example, that person who lives in the US was getting down payment assistance from a family member. The family member, who's a citizen of the United States, because they're not part of the marital relationship, they can't go on title.
Right. Well, so that's one of the exceptions
Mm-hmm,
to the rules is that if you are married, if you are a non-resident, non-permanent resident or
mm-hmm,
citizen, but you are married to a Canadian citizen or permanent resident, then you would still be allowed to purchase a home without the
mm-hmm,
restrictions. I think the ban is more targeting individuals who are foreign investors looking to speculate on asset value in Canada,
mm-hmm,
really just looking for a safe place to park their money. What they're hoping to do is free up additional home purchases
mm-hmm.
for Canadians so that people can buy homes that they're going to live in themselves. I think
Okay.
it does beg the question, though, do we actually think this is going to have a material effect on home prices?
Mm-hmm.
In my
I
opinion,
don't think so.
yeah, pretty much. I mean, I just don't think it targets specifically where a lot of the what we would call foreign buyers come into the market space with.
Mm-hmm,
They've done a good job by trying to limit some of the students, those here on student visas looking to buy, because that has been
mm-hmm.
a large percentage of buyers for sure that come in as a international in terms of international sources of funds. Um, but it still doesn't really drive it doesn't drive away one of the bigger parts of purchasing, which we know is Canadians looking to purchase additional rental properties or additional properties other than just their primary residence.
Mm-hmm.
You can still purchase in a Canadian owned and controlled corporation. So you can still have multiple Canadians pooling together money to invest
Mm-hmm.
in property.
Mm-hmm.
You're still allowed to get gifted down payment from non-residents to a Canadian resident in order to
Mm-hmm.
purchase. So if you're a Canadian citizen, your family is overseas and they have a lot of money, you could still go out and purchase several properties using gifted funds from overseas.
Right.
As much as there are um, some people who will be affected by this, I don't think the majority of the money that has been coming in will be. And historically, foreign buyers make up a really small percentage of our ownership in Canada, and specifically the like property owned by foreign individuals who do not declare taxes in Canada or residency in Canada. So,
Okay.
it's I think it's more of a political flag to wave, saying, "Look what we're doing," without really impacting a material part of the demand
So
that we
let's
can
talk
see in
about this a
markets.
little bit. We've got these three pillars, like we talked about, push and pull factors. Central banks, they control monetary policy, they control interest rates. That sets what a home end user is going to pay on their mortgage to borrow money. It also sets what their qualifying payment is with the bank, and that limits how much borrowing capacity they have. And when interest rates come down, that'll give them more borrowing capacity. We just covered the foreign buyer ban. That's the federal government putting this rule in place to try to mitigate who's buying homes. In an ideal world, this will create more affordability for domestic Canadians to be able to go out and purchase property. There's a lot of growing expectation now that interest rates are going to come down, which means qualifying payments are going to come down. People are going to have more borrowing capacity. There's the potential threat that that quickly reinflates the housing market. And central bankers have already said they'd prefer for that not to happen in the short term, slow and gradual growth. Now there's this third pillar. Let's just say interest rates become more accommodative because the economy is in fact contracting very quickly.
Putting
Let's talk
forward
about that
their
real quick. I
proposals.
mean, you know, what we know about asset prices and interest rates historically and even to recent memory. Interest rates fall 1%, asset prices typically correct around 10%. And besides interest rates, there's also just general borrowing capacity. So right now, if somebody can borrow gross debt service ratio, it's basically how much money the bank will give you based on your gross income. If they were to reduce that borrowing capacity by 10%, for example, that would have essentially the same effect as raising interest rates 1%. That could very well potentially drop home prices by another 10% based on very simple anecdotal math. That's sort of the direct implication of these changes.
Yeah.
But there's these more existential changes. And if you have been somebody who's inside the real estate market as a broker, banker, realtor, etc., one of the most polarizing things about real estate, you look at these affordability charts. It takes 10 times the average income in Toronto to purchase a place in Toronto. So how in the world do people do it? And that talks about the source of down payment funds, talks about potential co-signers on mortgages. If they really want to affect change, in all likelihood, it can be somewhere like that. Also, how many people own multiple properties? So will they allow banks to continue allowing people to borrow off their home equity to purchase secondary properties and certainly rental properties? We could potentially see some changes there as well, right?
Yeah, those aren't necessarily included in the proposals, but those are things
Mm-hmm.
that I think that they probably more likely should be looking at if their ultimate
Yeah.
goal was to try and bring housing prices down.
Yeah.
Because we do know that there are enough ways to help borrowers get, additional borrowing power or leveraging existing equity to increase those
Mm-hmm.
down payments. But yeah, for someone starting out without any sort of support, any sort of gift possibility, it's something like 30 years to save up your down payment for an average home in Toronto as an average income earner. Obviously, we know that's impossible and not sustainable. So it does beg the question: are they really targeting the correct, the correct policies to make material change? We do also know that OSFI only controls federally regulated institutions. So for the most part, those
Right.
are your big banks. That's what we call monolines, or bank equivalents that only do mortgages. But what it doesn't cover are your provincial guided institutions or governed institutions. Those are more so your local credit unions, Meridian, Duca, just to name a few big names. And
Alternative. Yeah.
those lenders have had policies designed since the introduction of the stress test that allow you to get around that. They are not limited to lending under those stress test regulations. I think today, for example, a credit union will provide you about 10 to 15% more borrowing power than a big bank will.
Mm-hmm.
If you see further restrictions on lending guidelines, it wouldn't surprise me to see lending pick up at those credit unions. Or in reality, a much greater percentage of fraud. People are still going to continue to find ways to get lending done, and I think these policies add risk to either pushing people towards looser regulation or looser lending programs, either with
Mm-hmm.
alternative lenders or credit unions, or it pushes them into hands of those who are willing to bend the rules or create documents for them, which we all know is the last thing that we want for stability in our housing market.
Mm-hmm.
To put some math to this, if we just put an example together, you have a current interest rate of 3.5%. You secured that roughly midway through 2018, and you took a 5-year fixed term. You'd be coming up to maturity towards the middle of 2023, and you're still on that 3.5% interest rate. So that's great. Most interest rate renewals that we've been seeing from clients are anywhere in that 5% range, but let's just pick 5.5 to keep that pretty easy. We're looking at roughly 2% or 2% difference between the rate that you have right now and the rate that you're being offered. Well, for every $100,000 in mortgage, that's going to be $2,000 for a year annualized in interest. if you actually go ahead and figure out what 6 months would look like, if you've got a $500,000 mortgage, you're obviously going to be, committing to paying about half of that annualized figure in interest for every 100,000. So it doesn't really give you a lot of advantage when you can either lock in rates today. We can submit applications for a good 120 days for most institutions, and help you avoid the overpayment in that interest figure.
Thanks for joining us again today. Hopefully you've enjoyed this episode. If you have, please hit that like, please hit that subscribe, leave a comment down below, and we will look forward to seeing you in the next one.